If we look at our business and we look at what are experts saying about the real estate business, I'd start here with mortgage rates by Freddie Mac. And really what they're saying looking forward is that we're in a very positive mortgage rate environment, in my opinion, going into 2021. They forecasted the 4 quarters of 2021 to be right at 3%. Now, if you look at NAR and you look at Fannie, Freddie, and the MBA, whoever's reporting interest rates, I would say they all are in the same sort of area, around 3%. I mentioned before, we're at 2.71 on the average 30-year fixed. Whether it's 2.71, 2.8, 3%, we're in a very, very good interest rate environment for those buying and should be going forward because they know real estate is driving the economy forward. And the projections are they continue to do that in 2021. Now, what you'll hear is that the rising yield on the 10-year Treasury is going to make mortgage rates get more expensive. And that certainly is the case typically in our business, but everything, the tailwind of the federal government right now is keeping rates low and certainly are forecasted to do that going into next year. If we think about the number of homes that are going to be sold going into 2021, we have NAR's estimate from Danielle Hale, the chief economist here, and she says this: we expect home sales in 2021 to come in 7% above 2020 levels. Now, here's the interesting thing. We'll sell more homes this year than we did last year, and we're expected to sell 7% more homes next year than we did this year. She goes on to say, following a more normal seasonal trend and building momentum through the spring and sustaining the pace in the second half of the year. While home sales are expected to lose some momentum over the last months of 2020, the shallower than normal seasonal slowdown creates a higher base of activity leading into 2021 that is roughly maintained for the first half of the year. And as vaccines for the coronavirus become broadly available to the public and economic growth reflects a resumption of more normal patterns of consumer spending, home sales gain even more in the second half of the year. We know we're going to have low interest rates. We're forecasted, and forecasters are saying we're going to sell more homes next year. It's interesting, she says this: we're going to have a good first half of the year, but she's forecasting an even better second half of the year. So as we get throughout the year and we get things, rolling again in the economy as vaccine and things like that continue to progress, you're going to see more activity come in the second half of the year. There are a couple of reasons for that, and I'm going to talk about those in a minute relative to inventory. But let's look at home prices real quick. The 2021 outlook for home price forecast, we've got 6 reporting agencies right here that are looking at 2021 forecast, what's going to happen next year. And you see those, anywhere from MBA to NAR there of the spectrum, 6% to 2%. If we look at the middle, we're looking more like, 3 to 4%, maybe 5% home price appreciation, throughout next year. Now, we've appreciated, widely held in a lot of different areas, around 7%. CoreLogic came out this most recent report and said 7.6% home price appreciation over the third quarter of the prior year. Now, we've seen hot appreciation due to extreme demand and low inventory. Remember, it's always going to be a supply and demand issue on price. And as we go into next year, this is what I was talking about before, experts are forecasting more inventory to come to market. Now, the interesting thing about inventory coming to market is to start to play out, where is that inventory going to come from? Several places. First of all, builder confidence for the last 3 months has set an all-time high in what they feel. Starts and permits are crushing last year's numbers, both up respectively about 25-30% over the same time last year. So we know builders are bringing more inventory back to market, and that inventory will start appearing, and that's really where kind of some of the second half inventory comes as they build those homes and they get those going. We know there will be people affected by the coronavirus and by the pandemic that will have to liquidate and sell their homes. I think we still need to be talking about forbearance and all of those things that go along with that, because people are being affected by that. And it's something we certainly don't need to stop talking about. The other area where we'll see inventory come to market are mom and pop investors right now that are being squeezed. There are people that are renting places that can't make the mortgage or the rent payment, and they can't make the mortgage payment. They may have to liquidate. Now, again, going back to what CoreLogic says in the position of equity, for those that may be impacted, whether they own a home or they're renting or an investor, whatever it is, the strong equity they have should help them get to the other side. And that's one thing that's very different today than what was happening in 2008, because this question comes up: are we going to see a lot of foreclosures? Now, I'm not going to go deep into that. The webinar we did last month, Facebook Live, you can go see it at keepingcurrentmatters.com. We talked all about a foreclosure crisis and why we won't see a foreclosure crisis next year. But Lawrence Yun said this, and I want to go to his quote. He said, "Any foreclosure increase will likely be quickly absorbed by the market, and it will not lead to any price decline." So this is a question, what's going to happen when foreclosures come to market? What will happen to all of those people? Is it going to, challenge prices? We've done an extensive amount of work at KCM on this, and I can tell you right now that the average number of foreclosures is 206,000 per quarter in this country, going all the way back to the 90s. Back in the height of the crisis, we saw roughly 500,000 foreclosures quarter after quarter after quarter in the housing market. And so we know this happens each quarter. We know that those things, we don't wish them upon anybody, but they're a fact of life. Let's look really quick at what's happening right now, the most recent data of those that were in forbearance relative to how they're coming out, because that's going to give us a purview into next year and what that what that'll mean for those folks. So of the 6.4 million, I'm going to call it, families and individuals granted forbearance, this is what's happened. The forbearance for a large majority of them, 2.2 million, was extended. Remember, you can do the first 180 days, extend for another 180 days. We're going to watch those 2.2 million. So, okay, what's going to happen with them? 48%, that next tranche of green bars right there, took forbearance and didn't even need it. They were able to say, look, I don't know what tomorrow's going to bring. I'm going to grab forbearance just in case, but I didn't need it. When this started, the narrative was 30% of the people are going to take forbearance, and every one of them is going to turn into a foreclosure. Simply not true. It's not how it's playing out. The gray bar there are still active in their original term, about 512,000 of those individuals. Now the red bars, these are ones that are interesting. 434,000 expired while delinquent and are in some form of loss mitigation, meaning a workout, meaning they're going through some type of deal with their bank, where the bank is doing what they can to help them keep the home. And that's what we said. Banks and the federal government do not want 2008 all over again. And you're seeing forbearance do the job that it was intended to do. 116,000 that have come out so far have expired while delinquent. Those are the ones we need to watch. And we say, okay, they are the ones that could turn into distressed asset sales and some type of deed in lieu, whatever the case may be, relative to to coming out of forbearance. So I'll kind of wrap up with this quote, because I think it's going to sum up what's going to happen relative to a lot of the patterns going into next year. It's from Realtor.com. It says this: more and more workers are finding the freedom to work remotely. This has sparked intense interest in suburb homes, further exaggerating a trend that had been slowly to emerge over the last couple of years. If companies require workers to return to the office, demand may wane. Conversely, if companies commit to long-term remote work, demand for these homes could see an additional boost in 2021. When we started, the pandemic, I think there was this thought of like, are people going to go back in the office, or is everybody going to work from home? What we know in the middle of that is going to be a lot of hybrid and a lot of different things that happen relative to people's employment. What do we know right now? There's a lot of uncertainty. People don't know exactly maybe what their business or their company is going to require of them. Are they going to have to go back in full time? Are they going to be able to work from home? Are they going to have some kind of hybrid scenario where they go in a few days a week? As people get more certain there, they'll then be able to make a decision relative to housing. And I think that's going to be a factor in a lot of home decisions going into next year. So count on inventory coming in, but things, again, like the blog that we posted today, Keeping Current Matters, there are a lot of reasons to be optimistic looking forward to next year.